This video will be about sales and marketing, research and development, and how tech companies funnel money into sales and marketing, research and development to grow their future earnings. Currently for Asana, they currently are posting negative net income, but they are funneling a lot of that money into sales and marketing and research and development. We have our 10K tier today. All right, here we go. So operating expenses for Asana. I'll post my previous video here first if you guys haven't watched it. It gives a quick rundown of the fundamentals, but this video will focus on sales and marketing and research and development. So here are the operating expenses for Asana. They have increased their sales and marketing and also research and development for the end of the year into 2025. I mean, just counting these two alone, guys, that's over $700 million going into sales and marketing and research and development. And just check out how it affects their income statement. So financials, income statement, we're going to annual. So 341 million plus 419, that is 760 million gone in sales and marketing and research and development. That is $760 million Asana is spending on research and development and sales and marketing. If they just stopped doing that, it would already be posting positive operating income and, of course, positive net income. $760 million, that's a lot of money to spend on that. So why do they do that? Why do they do that? Well, because they're a tech company. Most tech companies are deploying billions into sales and marketing and research and development to grow their future earnings. So this is all used as sound business logic, but it has the effect of depressing current earnings reports. So again, take a look at research and development, spending a lot there, and also sales and marketing, which is under here. Those two categories are causing the operating income and also the net income to be negative, and Wall Street hates that. Wall Street hates an unprofitable company. So let's talk about how in the digital age, the income statement is sort of an unreliable measure for these tech companies in tracking their long-term ability to generate positive free cash flow. Now, this is all because of our outdated accounting system where research and development and sales and marketing are automatically expensed in that year. So under GAAP accounting principles, so they nearly require 100% of the research and development costs and also sales and marketing. So 760 million total for Asana. They automatically require all these costs to be immediately expensed in this same year. So immediately, they must record a loss because of spending in research and development and sales and marketing. But under GAAP accounting, they allow hard assets like property, plant, and equipment to be depreciated over many years. How is that fair? How is that fair? It's not fair, but that's just how life works. And for Asana, because of that, they are posting negative earnings and negative operating income. So with old economy assets like factories, tractors, they are considered long-term investments, but unfortunately for tech companies in Asana, sales and marketing and research and development are expenditures, causing them to look like bad companies, but in reality, they're not. So Asana doesn't need factories, tractors, they don't need all these hard assets. Everything is intangible. The biggest investments that Asana can do as a company is developing their marketing products. So you sort of have to invert the way you think when you're researching tech companies, because sales and marketing and research and development are actually investments. So a total of 760 million is actually an investment for Asana, but they do have to expense it that same year. So $760 million, they are funneling into growing the future earnings of the business opportunity because they did post some really good earnings. I'm going to pull up the core customers, KPIs, some of the KPIs we're looking at. Remember, we have two core customers for Asana. One of them is customers spending $5,000 or more, and the other will be customers spending $100,000 or more. And so the growth rate for the customers spending $5,000 or more is an average of 10%, while the more focused group they are looking at is customers spending $100,000 or more, and that is growing at a 20% average rate. So if a company can spend marketing dollars and research and development to add profitable customers for years, so as you can see, they are still growing their customers quarter over quarter, year over year. It doesn't matter if it currently depresses your current earnings, because if you think about it in the long run, the more customers you have, the better network effects that you could build in order to make the company even better. And so Asana is growing, guys, just slowly, but they are starting to become a multiple revenue stream company. Software drives today's economy, and because software requires fewer assets to generate larger income streams, physical assets have become irrelevant. And so in the latest Q1 2026 earnings transcript, this just released yesterday. Let's take a look at some of the stuff they're saying about sales and marketing. So 26% of the revenue is spent on research and development, and 45% of the revenue is spent on sales and marketing. They are spending a lot on sales and marketing, research and development. Over 50% of the revenue alone is gone to sales and marketing, research and development. That is an investment for Asana. So when you go to the 10K, they keep increasing it. They're not slowing down. They're not slowing down on the sales and marketing. The stock is down 18% today after posting some good earnings. Down 18%. Wow. Here we go. It says right here. We believe our long-term value as a company will be greater if we focus on growth. So they are currently focused on growth, which may negatively impact our profitability in the near term and medium term. So this is a company you want to hold for the long term, guys, because they are funneling a ton of money into sales and marketing and research development. 760 million total last year. That is a ton of money. A significant part of our business strategy and culture is to focus on long-term growth and customer success over short-term financial results. They are posting negative results on purpose under GAAP accounting because of the sales and marketing, research and development. It just looks bad. The company just looks bad. Wall Street doesn't like how they are posting negative profits, but in reality, they are investing a ton of money to acquiring customers. So they do talk about how in the short to medium term, they are going to operate at a loss. They aren't slowing down on the marketing and expenditures to grow their platform. And so that's one of the main things they're doing. I mean, what else can this company spend on? I mean, they have to be funneling money into sales and marketing. So let's take a look at Fintel. Institutional owners are growing on Fintel. Looks like 2025, lots of institutions are jumping in. This year has been the highest amount of institutional holders. Our boy Dustin Moskovich hasn't purchased lately. Last time he purchased was on April 15th. And the company has authorized another $100 million share repurchase, total of $156 million of share repurchases moving forward. So at the current price, if they use up all the $156 million, they could buy over 10 million shares. So if Dustin Moskovich owns 51 million, they repurchase 10 million shares. That's about 60 million. With the total amount of shares float, 90 million, 1/3. Retail doesn't even know about this company yet. Institutions are loading on. All they got to do is turn some things around. Remember, guys, Asana is currently transitioning CEOs. That's why people don't like it. But the fundamentals have been improving in the past 3 to 4 years. 2024 is the first year of posting positive cash flow, positive free cash flow. They have a lot of cash, no debt, keeps on going down. I think this is the bottom for Asana. I mean, it's done nothing for the past 3 years. I think $13 to $15, I'm calling the bottom. I think this is the bottom. If it drops some more, the company is just going to repurchase the shares. They have 156 million in the share repurchase program. So take a look at my other videos. I do a full fundamental analysis on Asana. Let me know what you guys think below. I've been heavily following this company. If you guys like the videos, give me a thumbs up. Don't forget to subscribe, and we'll keep doing some updates on some stocks I like. But yeah, thanks for watching, guys. We'll see you on the next one.